I want you to imagine a global superpower. Like when I say those exact words to you, what is the very first image that pops into your head?
Probably something, absolutely massive.
Right, exactly. If you're like most people, you're picturing sheer, undeniable mass. You're picturing these massive land masses stretching across entire continent.
Oh, absolutely. And the resources.
Yeah, seemingly endless natural resources. Oil fields, vast agricultural plains, um, sprawling mining operations.
You're probably picturing massive populations, too.
Yes, massive populations and a sprawling military footprint, complete with aircraft carriers and, global bases all over the world. Basically, you're picturing size is the ultimate metric of power.
Which makes sense historically.
It does. But today's deep dive is going to completely flip that script.
It's a necessary pivot, really, because that traditional definition of global influence is becoming a bit, well, it's outdated when you look at how the modern world actually operates.
Right. And that brings us to the fascinating stack of economic notes, historical data, and financial analysis we are unpacking today. And it's all focused entirely on the Swiss franc.
A completely different kind of superpower.
Exactly. Our mission for this deep dive is to solve what I can really only describe as a macroeconomic mystery.
It really is a mystery when you look at the raw data.
It is. We are going to figure out how a small, landlocked European country with virtually zero natural resources.
Like literally no oil, no gas.
Right, no gas, very limited arable land. How they somehow managed to engineer one of the most powerful, universally trusted financial systems on Earth.
It's incredible.
And what makes this so incredibly relevant for you listening right now is that they've done this while major, massive global economies are constantly battling, crushing inflation, wild currency instability, and spiraling national debt.
And they achieved all of this without deploying any of those traditional hallmarks of an economic empire. I mean, no massive armies, no aggressive territorial expansion.
It's just incredibly precise financial architecture.
Precisely.
So let's jump right in. The core premise we are exploring today represents a total paradigm shift. I mean, the data points to a reality where the strongest currency in the world isn't built on physical size at all. It is built entirely on trust.
Which leads us directly to the concept of the Swiss franc as a global safe haven.
Right, a safe haven.
Yeah, to understand this, we have to look at how capital behaves under pressure.
Yeah.
Because in global finance, a safe haven is an asset that is, fully expected to retain or even increase its value during times of intense market turbulence.
Okay.
But the Swiss franc takes this to an entirely different extreme. It exhibits this counterintuitive behavior that just defies normal market logic.
How so?
Well, usually when global uncertainty hits, let's say a massive geopolitical crisis erupts, or we see a sudden, terrifying market crash like we did during the 2008 financial crisis.
Right, total panic.
Exactly. When that happens, most national currencies weaken dramatically. Investors panic and they pull their money out. Capital actively flees the burning building.
Makes sense.
But the Swiss franc does the exact opposite. When things get catastrophic out there in the world, the Swiss franc gets substantially stronger.
Okay, let's unpack this for a second. So if the global economy is, say, a giant mansion, and the kitchen suddenly catches on fire, it's like the Swiss franc is this highly fortified financial panic room.
That's a really good way to look at it.
Right. All the investors drop whatever they're doing, they sprint down the hall, and lock themselves inside that room until the fire burns out.
That's close, but with one really critical distinction. It's a panic room where the entry fee keeps going up the more people try to crowd inside.
Oh, wow.
Yeah, they aren't just hiding their money there. Their sheer desperation to get inside actually increases the value of the room itself.
Wait, I have to push back on the physics of this for a second.
Oh, for it.
In macroeconomics, strength in a currency like that gravitational pull that attracts money is almost always directly tied to the sheer economic size of the country backing it up, right?
That's the traditional view, yeah.
I mean, think about the U.S. dollar. Its gravity comes from an absolutely massive gross domestic product, a population of hundreds of millions, and the most powerful military apparatus in human history to enforce its interests.
Right. Physical and economic mass.
Exactly.
Yeah.
But Switzerland has a population smaller than New York City.
Huh?
How does a nation that tiny 3 defy the basic rules of macroeconomic gravity? They shouldn't have enough mass to pull in the entire world's wealth during a crisis.
Well, that assumes gravity in finance is generated by physical mass. But when we look deeply at the mechanics of global capital in the sources, we have to fundamentally redefine what currency strength actually means.
Okay, redefine it how?
It is not about sheer volume, and it's certainly not about military might. The gravity you're talking about is generated entirely by psychological certainty.
Psychological cert.
Yeah. Think about the mindset of an investor during a global meltdown. In a crisis, they aren't looking for the biggest country. They are looking for the country that is least likely to collapse, default on its debt, or, dramatically change the financial rules overnight just to survive.
Oh, I see. So their mass isn't land or people. Their mass is actually their stability.
Precisely. Their gravity is confidence. During extreme global uncertainty, the basic instinct of capital isn't to make a profit. I mean, the instinct is just survival.
Just don't lose the money.
Exactly. The Swiss franc strengthens because the global financial community collectively looks at the board and agrees that their wealth is least likely to evaporate there.
Right.
But confidence isn't just an aura, or a marketing campaign. You can't just declare your country a safe haven. That trust has to be rooted in a deeply ingrained, historically proven reality.
Which brings us to the ultimate stress test for any currency. If we're talking about trust, we have to talk about the #1 destroyer of financial confidence.
Inflation.
Exactly. Inflation.
Absolutely. Inflation is the silent, insidious killer of trust. When you look at the mechanics of how a currency collapses, it almost always starts here.
Right.
When inflation runs hot, it fundamentally erodes purchasing power. That means the exact same unit of money you hold today is going to buy you less food, less fuel, and less housing tomorrow.
Right, because the prices of those goods are rising, making the currency itself, well, weaker.
Exactly. And let's look at how that destabilizes an entire society. If you are a business owner, how can you plan a 5-year expansion if you don't know what your materials will cost next month?
You can't.
You really can't. Long-term planning becomes impossible, and ultimately it destroys the population's faith in the currency itself.
Which is terrifying.
It is. If you know the money sitting in your bank account is leaking value every single day, you are going to get rid of it as fast as possible.
Yeah, you're going to buy hard assets like real estate or gold.
Or you're going to move your wealth into a foreign currency. But Switzerland avoids this doom loop because they have consistently maintained, remarkably, almost stubbornly, low inflation.
But here's where I get a little stuck on the mechanics. Doesn't literally every central bank in the world try to keep inflation low?
Well, yes.
I mean, there is no central banker sitting in an office in London or Washington saying, let's crank up the inflation today and ruin everyone's savings.
Right. Nobody wants inflation.
So what is Switzerland doing that makes them the exception rather than the rule?
That is the crucial question, and it comes down to a distinction between wishing for something and engineering it.
Okay.
Yes, every country wants low inflation. But for Switzerland, it isn't just a stated goal that they hope to hit if conditions are right. It is achieved by strict design.
By design.
By design. And that design requires an incredibly painful level of monetary discipline. The Swiss National Bank, their central bank, makes conscious choices to prioritize long-term stability over short-term economic growth.
Wait, how do they actually do that? Like, what is the mechanism for choosing stability over growth?
It usually comes down to interest rates. When an economy starts running too hot and prices start rising, a central bank's primary weapon is to raise interest rates.
Right.
When you raise rates, you make borrowing money much more expensive. Mortgages get pricier, so people stop buying houses.
Corporate loans get expensive, so businesses stop expanding.
Exactly. They stop hiring. People stop spending money. You are intentionally cooling down the economy, which brings prices down.
But that means you are deliberately causing economic pain. I mean, you are slowing down businesses and potentially causing job losses in your own country.
Yes, it is an enormous trade-off. And most governments and central banks, well, they flinch when it comes time to inflict that pain.
Because of the politics.
Entirely because of the politics. There is immense political pressure in most countries to keep interest rates artificially low, to print more money, or to stimulate the economy to boost short-term growth.
Especially when politicians are facing an election cycle.
Exactly. Nobody wants to be the politician who slowed down the economy. But the Swiss policy framework is insulated from that political pressure.
Wow.
Their central bank orbits one single, uncompromising mandate: protect the value of the money. If they have to slam the brakes on their own domestic economic growth to prevent a spike in inflation, they will do it without hesitation.
That requires an incredibly resilient foundational structure. I mean, if politicians aren't allowed to storm into the central bank and demand they print more money to fund pet projects, the institutions themselves have to be ironclad.
They do, and this ties into a profound shift in the nature of money that really defines the modern era. We don't use gold coins anymore. We left the gold standard a long time ago.
Right.
Today, every major global economy operates on what we call fiat currency.
Okay, let's pause on fiat for a second just to make sure we're completely clear. That essentially means money by decree, right?
Correct. Fiat currency is money that is not backed by a physical commodity like gold or silver.
It's just paper.
It's just paper or digital numbers. It has value simply because the government issuing it says it has value, and the people using it agree to accept it.
Which is wildly unsettling when you really stop and think about it. I mean, the money in our pockets, the numbers on our banking apps, they are valuable simply because we are all participating in a collective, shared hallucination.
It is entirely a shared belief system. And because modern money is fundamentally just a belief system, it means fiat currencies are backed exclusively by trust.
Trust.
Yes, Switzerland recognized this decades ago, and they have spent generations deliberately cultivating this specific brand of trust.
Not through flashy global marketing campaigns, I assume.
No, not at all. They did it through boring, predictable governance, incredibly strong democratic institutions, and a legal framework that prioritizes property rights above almost everything else.
You know, it makes me think of how different countries steer their economies. You look at some major global economies, and they operate like high-speed racing boats.
Oh, that's a good analogy.
Yeah, they are constantly making these flashy, rapid policy pivots. They're slashing tax codes overnight to spur growth, launching multi-trillion-dollar stimulus packages, aggressively altering trade tariffs.
Constantly accelerating.
Exactly. Accelerating, turning sharply, trying to chase down maximum rapid growth. They are fast, but they are incredibly easy to capsize if a massive wave hits.
That's a great way to visualize it. So how would you describe Switzerland in that scenario?
Well, I'd say Switzerland is an oil tanker. It's not winning any drag races. It's steady. Honestly, it's boring.
Boring is a good word for it.
But it has this massive deliberate ballast of institutional weight. It takes miles to turn around, meaning there are absolutely no sudden moves. And that heavy, boring predictability makes it virtually impossible to flip over during a storm.
Boring is arguably the most highly underrated trait in global finance. When the global landscape is experiencing a period of extended calm, sunny skies and flat water, investors love the speedboats.
Right. They want to go fast.
They want to take risks. They want high yields and exciting returns. But the moment a massive geopolitical storm rolls in, when the speedboat starts violently pitching in the waves and looks like it might sink, that boring, heavy reliability of the oil tanker becomes the most valuable thing in the world.
Because nobody wants a surprise when they are terrified.
Exactly. In times of genuine panic, the guarantee of trust becomes significantly more valuable to an investor than the promise of a high financial return.
Wow.
It is the classic market pivot from seeking a return on your capital to simply demanding the return of your capital.
The return of it.
Yes, investors don't care about making 8% interest anymore. They just want to know their principal will still exist when they wake up tomorrow. That deeply entrenched institutional trust is the bedrock of the Swiss franc.
But here is where we really need to look at the consequences of all this. Because this deep-seated trust isn't just a philosophical concept. It triggers a very real, measurable movement of massive amounts of global capital across borders.
It does. Capital is incredibly sensitive. When geopolitical tensions rise, say a land war breaks out, or there's a severe global supply chain collapse, capital instinctively flows into stable systems.
Right.
It's exactly like water flowing downhill. It aggressively seeks the path of least resistance to safety. And Switzerland is consistently the ultimate destination for this migrating wealth.
Okay, wait. This is exactly where the math stops making sense to me.
Okay, where are you getting stuck?
I'm looking at this system, and I think I spot a massive flaw. Tell me where I have this wrong.
Let's hear it.
If billions of dollars constantly flow into Switzerland during every single global crisis, and let's face it, the world is always in some state of crisis, that means the global demand for the Swiss franc is constantly skyrocketing.
Yes.
People are selling euros and dollars to buy francs. And when demand goes up, the price goes up, meaning the franc becomes even stronger. Doesn't this create an endless perpetual feedback loop where the currency just gets endlessly heavier and more expensive?
You haven't gotten it wrong at all. You've identified the exact feedback loop that makes this dynamic so complex.
So it is a loop.
It is a powerful cycle. You start with a strong, stable currency. That inherent strength attracts frightened capital from all over the world. But that massive influx of new capital organically strengthens the currency even further.
Wow.
Money follows safety, which creates more safety, driving this continuous upward spiral of demand and valuation.
But hold on, a super strong currency sounds amazing if you're a Swiss citizen taking a vacation to Florida, right? Like your money goes incredibly far.
Absolutely.
But isn't a perpetually strengthening currency an absolute nightmare if you are trying to run a country that actually makes and sells things?
It is a profound challenge, and it's the exact reason why this safe haven status is a double-edged sword. Let's walk through the actual math of how currency strength can destroy an export economy.
Yes, please. Break down the mechanics of that because I want to make sure everyone listening grasps this.
Okay, let's say you own a manufacturing company in Zurich and you build high-end Swiss watches.
Okay. Classic Swiss product.
Right. You sell a specific watch for 1,000 Swiss francs. Now, let's say the global exchange rate is 1-to-1 with the US dollar. An American buyer pays $1,000 for your watch. Everyone is happy.
Seems simple enough.
But suddenly, a massive banking crisis hits Europe. Panicked investors flood into the Swiss francs, driving up its value. Within a few months, the exchange rate shifts. Now, it takes 1.5 US dollars to buy a single Swiss franc.
So the currency just got 50% stronger.
Right. Now, you haven't changed a thing at your factory. You are still selling that exact same watch for 1,000 Swiss francs.
Right.
But because of the exchange rate, that American buyer suddenly has to pay $1,500 to get it. Overnight, without changing your product or your business model, you just became 50% more expensive to the rest of the entire world.
That would completely wipe out most businesses. I mean, your global customers would just stop buying from you and go find a cheaper competitor in Germany or Japan.
Exactly. And this isn't just a theoretical exercise. We saw this play out violently in 2015 during an event the financial world literally called Frankageddon.
Frankogeddon. That sounds intense.
It was. For years, the Swiss National Bank had kept a cap on the franc to prevent it from getting too strong against the euro, specifically to protect their exporters.
Okay.
But the pressure became too great, and in January 2015, they unexpectedly removed the cap.
Oh, wow. What happened?
Chaos. The Swiss franc surged by roughly 30% against the euro in a matter of minutes. Minutes. Imagine being a Swiss CEO, waking up, having your morning coffee, and realizing your goods just became nearly a third more expensive to your biggest trading partners while you were sleeping. Exporters were terrified.
I bet they were. So if that's the reality, if their currency is perpetually acting like an anchor on their own global prices, how does Switzerland avoid total economic collapse?
That's the billion-dollar question.
Right. A country cannot survive just by acting as a giant alpine vault, hoarding other people's frightened wealth.
No, they can't.
If the only thing Switzerland did was store money, their strong currency would make everything they try to sell so uncompetitive that their internal economy would implode.
That is the ultimate realization. To prevent this incredibly strong currency from crushing their domestic market, Switzerland relies on a very specific, meticulously engineered type of economic engine.
Well, they clearly can't be relying on mass-produced consumer goods.
Absolutely not. The data details the actual structure of the Swiss economy, and it is built completely differently than most nations.
How so?
Despite the common stereotypes, it isn't just private banks and chocolate factories. The country focuses intensely on what economists call high-value, specialized industries.
Like what?
Specifically, pharmaceuticals, advanced manufacturing, and specialized finance.
Oh, okay. So if you're trying to compete globally with a currency that makes everything you sell super expensive, you can't run a dollar store.
Exactly, let's use that. If you run a dollar store or a business mass-producing cheap plastic toys or like basic textiles, your profit margins are razor thin.
Right, because you are competing purely on price.
Yes. If your currency gets 10% stronger, your margins are instantly wiped out and you go bankrupt.
But if you run a luxury boutique...
If you run a luxury boutique, you aren't competing on price. You are competing on quality, precision, and exclusivity. And that brings in a crucial economic concept: inelastic demand.
Break that down for us. What does inelastic demand mean for these specific Swiss industries?
It means the demand for the product doesn't dramatically change just because the price fluctuates.
Okay.
Let's look at pharmaceuticals. Switzerland produces highly advanced, specialized medications. A patient needs their life-saving leukemia treatment regardless of whether the Swiss franc just went up 15% against the dollar.
Wow. Yeah, they don't have a choice.
The demand is inelastic. They have to buy it.
And what about advanced manufacturing? Because I'm guessing we aren't just talking about luxury watches here.
No, we're talking about highly specialized precision engineering, medical devices, intricate components for aerospace, specialized
The
robotics.
stuff you really don't want to break.
Exactly. You can't easily outsource that manufacturing to a country with a cheaper currency because you instantly lose the expertise and the precision.
Right.
Because these industries are based on an incredibly high level of expertise, they are remarkably resilient. Buyers around the world are forced to pay the premium for Swiss quality because they literally cannot get that level of precision anywhere else.
So their exports survive the currency trap because they make things the world simply can't refuse to buy.
Precisely. And this completes the entire macroeconomic system. The nation's strong, safe haven currency isn't just a financial illusion. It is tangibly backed by an equally strong, highly productive, specialized economy.
The currency and the economy reinforce each other.
They absolutely do.
So bringing this all together for you listening, the overarching lesson we can extract from this deep dive is that Switzerland's absolute financial dominance is no accident.
Not at all.
It wasn't a stroke of historical luck, and it certainly wasn't due to sheer mass or an endless supply of natural resources.
Which they don't have.
Right. In a global landscape where currencies are constantly losing their value to runaway inflation and politically motivated debt, Switzerland looked at the board and decided to play a completely different game.
A very deliberate game.
They focused entirely on preserving value. They did it through unwavering monetary discipline, through deep, unshakable institutional stability, and by building a specialized economy immune to the trap of cheap global competition. In short, they didn't just build wealth, they engineered trust.
And exploring how they engineered that trust leads us to a really compelling, almost philosophical question. Something for you to ponder long after this deep dive ends.
I love a good philosophical question. What is it?
The economic reality is undeniably clear. Today's fiat currencies are backed entirely by trust, not gold. Switzerland spent decades, maybe even centuries, slowly, methodically, and painfully building that institutional human trust.
Right.
But look at where the financial world is aggressively heading right now. We are entering an era of decentralized digital currencies. Yes. Cryptocurrencies and blockchains are actively attempting to replace central banks and human institutions with algorithmic trust, with pure, unfeeling code.
It's the ultimate attempt to engineer trust by entirely removing the humans from the equation.
Exactly. So the lingering question is this. Can a decentralized blockchain, no matter how perfectly coded or mathematically sound, ever truly replicate the deep, psychological safety of a physical nation that simply refuses to panic?
That is a fascinating question.
Right. When the next massive global crisis inevitably hits and fear takes over the markets, will people instinctively trust a decentralized algorithm? Or is human predictability, the boring, steady, reliable oil tanker, the one asset that technology can never actually replace?
It really makes you wonder if that financial panic room will always require a human hand on the lock. Think about that the next time you picture what a global superpower truly looks like.